It is Wednesday, March the 22nd, 2017. I'm Gord Long. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I'll pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's macro online updates. The research document this month updates regional economic developments. Therefore, the slides this morning will focus on our other three report areas, the global risk, macro, and U.S. developments. This month, I'd like to focus on three specific subjects and how they relate: liquidity, credit, and the EuroDollar. Financial liquidity is critical during a crisis, but under normal conditions, it's only as good as the credit debt it fosters. On a global basis, the credit itself is only as valuable as the currency it is actually issued in. Let's talk about liquidity first. The financial markets have until recently been rising at historical and unprecedented rates. This is easy to understand if we simply don't forget that central bankers are still pumping approximately $200 billion per month of liquidity into the global financial system. After the U.S. ended the taper program, and in year beginning 2016 as the market swooned, the ECB, the Bank of Japan, and the Bank of England took up the gauntlet as part of former Federal Reserve Chairman Ben Bernanke's enrich thy neighbor doctrine. If 90% of the world's currency trading is in four currencies, and they are debased in a controlled and managed fashion, he felt, then people have no frame of reference of the degree of currency debasement. Historically, gold and silver would have flagged this, but clearly based on the number of indictments on these markets being manipulated, they are no longer a reference measurement. So therefore, if the four currencies, in a coordinated sequential fashion, inflate their currencies, then in fact the debasement is relatively transparent. In addition, we recently discovered that starting around the same time as the Trump election victory, the U.S. Treasury suddenly injected an additional $200 billion into the system, a one-time injection. This injection is going to wreak havoc with Treasury cash shortage, with the debt ceiling limits being reinstated March 15th. We can only speculate here why this was done. This was not a Trump administration decision. Though Trump may have gained some short-term euphoria for the market rise during his first 100 days, it may turn out to be a boomerang that comes back to seriously hurt him when his proposed stimulus spending and tax cut programs don't meet the fiscal debt ceiling restrictions or what they're approved to be. Frankly, it looks like a setup to me. Let's talk about credit, because clearly we can see liquidity is still flowing at unprecedented historical levels. But what happens with all this liquidity? Is it being turned into credit? It certainly looks like the banks have little interest in taking credit and lending risk right now. Commercial bank loan creation on a year-over-year basis is falling faster than the onset of the financial crisis. Notice the slope of these two periods here on this chart. With a rolling 4-week decline of 2.8%, this is serious. But of course, no one is talking about this when the markets are going up and retail money is flowing back into equities while institutional money continues to exit, or at least hedges. The lending slowdown is broad-based. The auto industry, as an example, has been setting records, and it seems to me everyone, whether they have a job or not, are driving a new car, at least up here in the Northeast. A cash for clunkers program, like we saw during the previous crisis, wouldn't work today, I don't believe, because there just aren't any clunkers, at least here, as I said, in the Northeast. We have talked previously that we believe the U.S. credit cycle has actually turned, or is turning. We initially based that on the fact that corporate cash flow, or EBITDA, to revenue is falling. This places pressure on credit ratings, and in turn on lending covenants. It isn't just about the existing loans, but about the trillions of dollars of existing loans being rolled over. New terms not only mean higher rates, but more restricted covenants, the posting of more supporting collateral. With everyone so highly leveraged to squeak out additional yield, they have nothing left to post in many cases. That's where the credit crisis starts to loom. It isn't just corporate lending, though. When household wealth to income ratios reach these levels, unprecedented levels historically, it means asset values are too high to reach for based on income. Household cash flow can't make the payments for the higher priced assets. Lending, therefore, is forced to slow. Credit gets more difficult. Goldman Sachs Financial Conditions Index has been worsening since mid-2016 and diverged from a weakening equity market with the Trump election victory. Either the Trump election euphoria quickly turns into fiscal government programs to stimulate the economy and will in fact improve financial conditions, or things will get significantly uglier fast. We also believe that we are late in the business cycle, and it is turning. It has been 8 years since a U.S. recession, and one should be expected. Central banks and politicians have never shown they have the ability to stop this cycle. I don't think anything's changed here. It is a healthy part of the capitalist system where excess leverage and malinvestment is purged during this turndown or these recessions. When it's deferred for too long a period of time, the excess leverage and malinvestment rises obviously higher, and therefore the turndown becomes even more serious. Today, the possibility of this happening is politically unacceptable. The truth is, leverage is so great that what it could unleash may be uncontrollable. If I was the Fed, it would keep me up at night. Of course, with Yellen raising rates, she sees things completely different. I have consistently watched the Fed get the credit and business cycle wrong over the years, and often they have been the culprits whose policy action actually triggered the recession. This may be the case and certainly looks like it once again. Besides the rise in distressed debt, slowing of leveraged loans, we are also again seeing cracks in high-yield bond markets as prices fall and yields rise, another clear signal. These are all signs, as I said, of a turning credit cycle and business cycle, especially when we see rising delinquency levels and credit card charge-offs on consumer credit cards. They're at Great Recession levels already. We also need to remember that a big driver of the stock market's rise has been corporations borrowing vast sums of money to buy back their shares to increase earnings per share on falling earnings and additionally to pay out dividends. Stock buybacks have alone totaled $1.7 trillion over the last 3 years since January 2014. By buying back stocks, corporations have effectively significantly reduced the pool of stocks available to buy. Add to this, central banks, and at last count we counted 12, are now buying equities as part of their monetary policy with freshly minted money. Is it any wonder equity markets are rising? The question is, why aren't they rising even at a faster rate? Additionally, with everyone chasing yield, stocks that pay out dividends effectively through borrowed money have been highly popular. These borrowing costs have been low. They're now changing. The LIBOR rate is the real determinant of the cost of money. Money is getting more expensive. It could easily trigger an unexpected financial event or black swan. Certainly there is lots of worry about such a thing out there. I recently posted a number of charts and articles regarding what the U.S. Treasury yields and the yield curve is beginning to signal. Up until last week's FOMC meeting, it was adjusting to the debt ceiling and credit worthiness that would precipitate in regards to U.S. Treasuries. Remember, these things are priced in well in advance. Our chart shown here has been very accurate for some time now. The small insert shows the long-term channel of the 10-year U.S. Treasury, suggesting an eventual high somewhere in the area of 3% in late 2017. As we go into the spring, the movements in the yield curve is telling us that the worries of stagflation will begin to dominate, and they're certainly beginning to be baked in. We think we are right on this because the reaction of the March 15th FOMC decision was not what normally occurs to markets when the Fed raises rates. Yields plummeted, the dollar fell, gold rose, and markets rose, at least initially, until quadruple witch and the vernal equinox arrived. We warned of these dates in our key dates chart in our market highlights section on the MATA SII website. I found this credit chart from UBS and Haver Analytics particularly telling. This degree of drop is serious. To me, it mirrors the degree of global trade slowdown. Remember that the 2007 financial crisis initially stemmed from the financing of global shipping costs. It flowed into the federal fund, breaking the buck in the monetary markets, then to asset-backed securities and mortgage-backed securitization. Once it starts, it can potentially and rapidly spread. Let's shift now that we see the issues with lots of liquidity, tightening credit, and talk about the EuroDollar. The credit must be used in terms of its currency. The biggest currency in use in the world is the US dollar. Its usage between non-US trading partners is referred to as the EuroDollar. A shortage of dollars compounds a credit issuance problem. One way of causing a dollar shortage is for foreign countries and institutions to sell their holdings of U.S. treasuries. The buyers of those surrender U.S. dollars, thereby draining U.S. dollars from the credit system. The sellers who receive the dollars are using the dollars to shore up their slowing economies and pay U.S. dollar-denominated debt, which has been rising as the dollar's strength cripples their ability to pay it from a weakening domestic currency. There has been over $7 trillion of U.S.-denominated debt issued since the financial crisis, and various versions of quantitative easing and ZIRP have been initiated. The rate of selling has been increasing, and if not soon slowed, is going to create a problem for the U.S. to finance an increasing national debt. The biggest culprit is China. My friend Thorsten Polet sent me this chart, which I annotated. If you study it, you see that the Federal Reserve has been keeping the euro-dollar credit spigot open by issuing U.S. dollar liquidity swaps every time things get problematic. We are again at that point. Rapid drops of 20 to 40 basis points in the euro currency basis one-year swap have been triggering this event. What we don't understand is why the response for the Fed has become weaker. Something is holding them back, or at least temporarily, but clearly we're in another event. I have done macroanalytics videos where we discuss the Triffin paradox. Simply said, the paradox is that an increase in the U.S. deficit is critical to credit creation and growth globally. Bad for us is good for others. When we owe $1 to China, for example, they post that $1 as a bank liability, with which they, through their fractional banking system, create an additional $20 of new lending. And improving U.S. places pressure on new credit creation, at least global credit creation. This credit creation has been circumvented since the U.S. current account balances has been reduced through quantitative easing and ZIRP bank lending. But both are changing. Where and when this ends is impossible to predict accurately. What we can see is that historically a strong dollar, which we have, leads to a global crisis in some country one way or another. I would guess it's probably going to be China, but that's a guess. That crisis in turn eventually, longer term, leads to a weaker dollar, which ushers in a U.S. recession. This is a consistent cycle. The question is just how rapid. History never repeats itself, but it often seems similar. Look for an international black swan sometime in 2017. In closing, remember the answer will be, and always has been, for all these crises, they will just print the money and keep that liquidity flowing. It is the only answer politicians will ever agree on. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2017 turn out to be an outstanding investment year for you and your family. Thank you for listening.